Good morning, everybody, and welcome to the Daily Energy Markets podcast. It is 10:30 UAE time, and Brent crude oil is trading little change, a little soft this morning, $82.68. It would seem the comments out of Iraq over the weekend, we won't support OPEC cuts in the second half. We will align with OPEC in the second half, Saturday, Sunday kind of commentary has had little sort of influence in the direction of travel in the markets this morning. It would appear Omar Najia, global head of derivatives at BB Energy, leads us off every week. Omar, the big narrative here is Q1, we saw a steady climb up from $75 on Brent to $90 or so on Brent, $5 each month, a steady, consistent, although not every day, but the average was $5 each month. Since the first few days of April, it's been a steady reversal of that, and that seems to continue. Your thoughts on why that reversal has happened, and does it continue to go softer from here after sort of 6 weeks of it?
No, I think basically markets, they never go up or down in a straight line, right? So they go up, they correct, or they go down, they correct. So no, this is normal. If you look at anything, corrections can be anything from 23% to 76%. So this is about 50% plus or minus. So not too hot, not too cold, and just about in the middle. So no, I'm not. I mean, I think you have to view markets. I like to view markets as a kind of whole, or at least look at other markets together with oil, and not just basically try and focus on, supply demand or a news story here or a news story there, right? So what we've seen this week, we've seen the dollar start to weaken. We've seen gold start to move back to the upside. We've seen Bitcoin holding the $60,000 level. And we've seen oil set a low at least WTI 76.70 plus or minus. So as long as that holds, basically, I think that low is it. Could it drop and go down to 75? Yes. Would I buy it? Yes. Has Nat Gas, if you look at Henry Hub, has Nat Gas set a low for the year? Yes. So it's again, it's a very difficult idea to basically try and say that you should be strategically short energy at these levels. It really is. So maybe some will be looking for, I don't know, $10, $50, 30, or whatever it is. But I think basically that the risk on energy prices is to the upside. As I say, if you look at Nat Gas, it's off to the races, and it's early in that move. And I think oil will follow. And if I look at exogenous markets, I think they will all follow to the upside as well. So yeah, I wouldn't sell anything. I wouldn't sell a house. I wouldn't sell a car. I wouldn't sell anything. I'd sell the US dollar, but apart from that, I wouldn't sell anything.
Clyde Russell, Asia commodities and energy columnist at Thomson Reuters. What are you selling, Clyde? Selling some insight, I hope, on China. How is China navigating all of this price volatility? Up the top end of the price range in the first quarter, now down, down, down?
Well, I think if you look at more than just crude oil, China's become a price-sensitive buyer of commodities in the last year or so. So if I was looking at their imports for the first 4 months of the year, where have their imports been strong? Iron ore and coal and nat gas in the form of LNG, some pipeline stuff there too, but mainly LNG. What is a common theme in those three commodities? Prices were weak in the first quarter. They were on a declining trend. Now, that may have been arrested in the last few weeks, but we're talking the imports of the first quarter or the first 4 months, and they were secured at lower prices. Where have imports in China been weak? Crude oil, and to some extent copper. What's been the trend in crude oil and copper? Rising prices. So I think what you actually see is that China, when prices are rising, and they believe them to be rising a little too quickly or going too high too rapidly, they pull back on imports. When prices are cheap, they tend to buy more. And I think that's a dynamic we're sort of looking at now. If you actually look, China's crude oil imports in April were 10.88 million barrels a day. Other than a weak February, that's the weakest month since the previous April. It's very hard to construct a positive demand narrative from China when you're basically having pretty soft imports.
I mean, from the point of the demand, the imports, whatever one calls them, soft or hard, so to speak, 10.88 versus maybe 11.88. But in either sense, can we translate how much is the consumption? Is the consumption adjusting? How much are they drawing down on stocks when oil prices are higher?
Well, it's always difficult to get a handle on stocks in China. The way I do it is I basically look at what is the volume of crude they have available from imports and their own domestic production, and I subtract the refinery processing from that total. If you do that, we have yet to get the numbers for April, but if you do that for the first quarter, they actually added to stockpiles. And at the same time, they were exporting less product than they did over the first quarter last year. So what you're really saying is that, you know, there's not really a huge demand driving picture in China. They've been adding to stockpiles. Yes, they have exported less in the way of refined fuels. But at the moment, you're sort of saying the demand it's not really that strong. If they were drawing on stockpiles, if I had strong evidence that they were drawing on stockpiles, and I will say that some of the tracking services believe that they are, but that's not really supported by the import, production, and refinery numbers. It suggests that if anything, they're actually adding. So I really battle to see a convincing argument anywhere that China's oil demand or consumption is strong.
Mark Ostwald, Chief Economist and Global Strategist at ADM Investor Services International. Mark, do you see anything that indicates that this sort of 6-week downward draft on the Brent, since we were at 90 and change in early April at the end of the first quarter, we're now literally every week down, down, down. But we're down at 83 on Brent, which is ultimately more or less the average for the year to date. Is this the floor now, or are you seeing anything that indicates that it's not going to go down further?
Well, the downside risk definitely comes from if the US economy slows significantly, and unless we see a real pickup in Chinese domestic demand, which we're, it's much hoped for, and everyone sort of overinterprets a lot of the incoming data, but it's at the end of the day, it's not really the profile of Chinese demand isn't changing much. In the US, there are some downside risks, but other than that, the overall profile to me suggests we're still range trading, and we are, as Omar was suggesting, towards the bottom of the range. Because the world economy is doing a little bit better than people had expected. Our wild card in all of this is basically there is a lot more drive to be more efficient in our energy use, and it doesn't really matter what we're talking about. So to some extent, the demand profile is probably not going to be as good because we're always basing our forecasts on back data. Which doesn't necessarily pick up the nuances of efficiencies which have come into the system. So it's a complex picture, but at the moment, I would still say the risk of geopolitical disruption, the risk in terms of global growth, despite a potential for the US to slow a bit, is still on the upside, and per se, that would be basically a positive, particularly if the dollar were to fall, and it would fall if the US economy slows, for energy prices.
Omar, I won't ask Clyde this question because ultimately Reuters are reporting that, in this difficult sort of track of commenting on the horse race, why oil prices are starting the week softer, they still point towards the strong dollar as a downward draft on oil prices. Your thoughts on that as an impact?
Well, I mean, maybe they're looking at a different market than I am, but the dollar's not strong. I mean, anybody who thinks so you got to look at, I mean, you can't kind of focus in and look at today and what happened yesterday and say, look, the dollar's strong. The dollar set highs against the euro and the GBP, right? The euro was, I think, 93 cents, and the GBP was something like, I can't remember now, 103, 104, something like that. And then basically it dropped like a stone. So it went from, let's call it 1 against sterling to 125, plus or minus. That's not a weak dollar. I mean, that's a weak dollar. That's not a strong dollar. The question is, what happens from that low? And we think that that low ended a 12-year up cycle for the US dollar against the GBP and against the euro. In other words, you spent 12 years getting the dollar to be worth, to be almost at parity with sterling, and to be worth more than the euro. 12 years. So we've had since that time about a year, right? So people got to be like a little bit patient, but we think that that is a trend change. And basically anything that I read about the US, about spending, about deficits, about interest rates, about inflation, about the fact that nobody can get elected in the US if they're going to raise taxes or if they're going to cut spending. If you read about how much they're paying in terms of debt, the interest on their debt, if you read that debt is going up by $1 trillion every 3 months, you can the US dollar might get stronger, but I would seriously doubt it, which is why people are buying gold. And it's like, 2,000, 3,000. It's why people are buying copper. It's why people are buying, all kinds of commodities. It's why people are buying the S&P. They're buying 7 stocks in the S&P. Why aren't they buying the rest? Because they've got all this cash that's got no home. So what do they say? Are they going to look at like the earnings of Apple, or basically the return of I don't know what, and how many assets? And no, they don't care. All they do is they've got some money. They don't want to keep it in cash because they know that cash is being devalued. How do they know? Because the price of eggs goes up, the price of this goes up. So what do? They go and buy the 7 standard stocks that you buy, too big to fail in the US. That's why they're performing like this, and the rest of the market is performing the other way. So the US dollar is not, de-dollarization is gaining, by leaps and bounds, right? So the idea that this dollar is going to be strong because they're, printing it like I don't know what is, I would bet against it, frankly. And before, what Clyde was saying and what Mark was saying, they're saying the same thing, except from different points of view. Mark is more bullish. Clyde thinks that China, is having a hard time recovering. But what I would say is they're saying the same thing, because the oil market is looking forwards. It's not looking at now, it's looking forwards. So China, what we would say is that it's not going to weaken anymore. It's highly unlikely to weaken more, right? What's likely is it strengthens, whether you look at it this month, next month, 6 months, 4 months. So, when you think that, lows are in, when you think that basically market is moving sideways after having come off from $130 on oil down to about, 70, 80, where it is now, you can do one of two things. You can say it's going to zero because Iraq is saying, I don't know what, or you can say, no, I think these markets are going higher. The S&P is printing 5,200. I don't know how that is a sign of a weak economy. What it is a sign of is I want to buy anything that's not fixed to the ground. If it moves, buy it. If it doesn't move, buy it until it does. So I'm not selling.
Clyde, Russell, your thoughts? Over the weekend, we had this drama with the Iraq comments regarding a possible breakdown in OPEC, commentary and OPEC solidarity, alignment, everybody reading off the same hymn sheet, as the saying goes. But as we get closer, the next 2 weeks into this June 1st meeting, inevitably there's going to be a lot of comments dropping off the tree. But as it's the first one of that kind of red zone commentary, the market barely blinked this morning on what appeared to be, even though pulled back a lot on Sunday, but nonetheless, an appearance of reluctance, an appearance of hesitation of some sort. Your thoughts on the market reaction to the Iraq commentary?
I think the market reaction was actually probably sensible. It was one of those cases of much ado about nothing. I'm always loath to criticize the media since I still sort of work in the media, but it really was a case where the headlines didn't actually match the hype, didn't match the reality. So I don't actually think it was that important. If I was trying to say, what does this ultimately mean? I think what you're actually seeing within the OPEC Plus group is a reluctance to deepen any output cuts in order to try and raise prices a little bit higher. I think the message that you're getting from several sources within that group, credible sources, is that they're likely to extend them and roll them over and keep them in place. From an OPEC perspective, oil's still a little bit weaker than where they think it should be. I think they'd be happy with the base more around $90 a barrel, and not closer to 80. So how do they actually do that? Well, they keep their output cuts in place, and then they hope that actually Omar is absolutely right, and that China and the rest of the world is going to have a stronger second half. I actually think he is probably right. I think there's increasing signs to me that the Chinese economy is starting to gain some momentum, and that does suggest that the bottom is in. But I must admit, I'm a bit of a guy who waits for the data to confirm it rather than live in the hope that that's what's going to happen. But overall, I think if you actually see a kind of recovering China, recovering rest of Asia, yes, it should actually lift the oil price, which suggests that OPEC will just sit on its hands. One other thing that I did want to say about what Omar was talking about in the dollar and currencies. He talked about euro and the sterling, but does that really matter in Asia? I would argue it doesn't. If you look at Asian currencies, they've been pretty weak against the dollar. Yes, they might have made a little bit of gains recently, but the yen has been weak, the yuan has been weak. Where I live in Australia, the Aussie dollar has been fairly weak against the US as well. And retail prices for petrol, diesel have been high and remain high by historic standards in these countries. That's got to have some kind of crunching effect on demand. And I think that's where part of the problem is. If you're actually looking at what consumers pay for fuel at the bowser, they're paying high prices.
Mark, I'd welcome you to pick up on that sort of train of thought there by Clyde, and picking up from Omar's comments about the dollar and the S&P. It seems to me, as the saying goes infamously, the market can stay irrational longer than you can stay solvent. I.e., the idea that the dollar strength at the moment, whatever the underlying logic or madness of when you've $33 trillion of debt and yet the dollar remains at 160 on the yen and 106 or 7 on the euro. I mean, the logic isn't present, but the reality, the irrational reality is there, and that has a dampening effect on the mood, on the demand mood. Your thoughts on that going forward?
Well, I always look at the G4 central bank balance sheets, and yes, it's come down from 26.5 trillion at its peak during the COVID period down to 20.5. That's still $20.5 trillion of money looking for a home. And a lot of it can be put to work defensively and generate huge amounts of income, which I think is something which people don't talk about enough. If your risk-free capital returns are 5% plus, which they are on T-bills, you're sitting there saying, I'm very, very happy. And then some of that money can be put to work in risky assets. So I think that the support there is still going to be there for risky assets, even though there are a lot of other things which are flashing warning signs. The huge, I mean, an example of how much people are putting money to work in things which have outperformed enormously. The US dollar corporate bonds have outperformed government bonds by a metric which defies belief. It's the strongest performance in 100 years, not 5, 10, 15. So there is a voracious appetite for corporate debt, even though if you actually have a look at the earnings in the US recently, the S&P 500 looks quite good. But if you actually look at the US dollar corporate bond world of domestic issuers in the States, actually they've missed their earnings by around about 7%. They've deteriorated. So there's quite a lot of, just hunting around. And it is because I think there's just too much central bank support out there. We're not as restrictive with interest rates where we are at the moment as a lot of people think. Yes, we're not used to it because we haven't seen interest rates at these levels for, getting on for 20 years since before the global financial crisis. But there is still a
I mean, in
voracious
a way,
amount.
it feels a little bit like 5% is sort of like your floss on your teeth that you're using to restrain a wild stallion horse.
Indeed, yes, I couldn't agree more. The underlying inflationary pressures in the world, if you look at it from a commodity perspective, the demand will pick up. Our problem with practically all, we don't really know what the long-term oil and gas demand's going to be. We don't know how battery metals are going to bed down because we don't know which technology is going to win out for EVs. So what we've got basically is a long-term upcycle in commodities, and I'm talking decades, but it's one which is really jagged. It's a sort of scenario where you can go up 150% suddenly because everyone's getting enthusiastic as they are about AI. And then someone says, actually, well, the demand doesn't appear to be materializing, so you fall 90%. And it's that sort of, very volatile from a long-term perspective thing that we're dealing with.
Let's go to the survey question, which is touching on the points made through our conversation this morning. If we can bring that up, what will determine China's appetite for oil imports in the second half, plagiarizing Clyde Russell's great article that was published today. International oil prices or China's economic growth? What will determine China's appetite for oil imports in the second half? Omar, I mean, looking at the trends for the second half, we're obviously trading already July contracts, delivery, and we're already moved through this sort of from the point of view of delivery into deep into the second half. And obviously, as you articulate, we have the continuation, whether for whatever multiple reasons, the stimulus, huge liquidity, but China isn't really participating in that. Are they missing an opportunity? I mean, everybody's printing money. Why not do the same?
Why not China do the same? Well, they're doing the same. They're doing the same. That's why, they're supporting their equity markets. They're supporting their real estate market, et cetera, et cetera. So they're doing the same. Everybody's doing the same. Every single central bank basically is out there debasing currency. I mean, you need to look at Bitcoin trading at $60,000 to realize that something is not right. Okay.
When a useless little drip of a sort of code of software is worth $60,000, it's time to go to Mars. Clearly.
Well, I mean, it's a very interesting thing because Bitcoin is the only thing in the world that has no excess supply. So its supply is fixed forever. Everything else, every other commodity, you can make more of, right? Gold, you can just dig and find more expensive gold. If gold is worth $10,000, you could go, let's say, 10 miles down into the earth. So every single commodity you can make more of, except Bitcoin. And again, when people they really don't understand. So if you look at the Mona Lisa, right, and you say, well, it's $100 million. So what makes it worth $100 million? Is it the paint? Is it the canvas it's printed on? Is it the fact that, somebody who, nobody's ever seen died, I don't know how many years ago, painted it? Why is it worth 100 million? It's worth 100 million because the market says.
That seems cheap.
Yeah, because the market says it is.
That's only 7 Bitcoin.
Yeah, and it's basically, the other thing is that it's very susceptible. It moves, something that's unique. When inflation increases, it increases a lot. So maybe art by somebody else, let's say Picasso, would move 30%, but the Mona Lisa is going to move 50 or 100%. Same with Bitcoin. Anything is worth what people will pay for it. And the thing about Bitcoin is it's basically a way to preserve your wealth. People say store of value, digital gold, you name it. But right now, people are looking at Bitcoin saying, well, why? But eventually, when it gets into the, hundreds of thousands plus, everybody's going to be scrambling. And the idea is that the US and the West in general has no alternative except to keep printing money. There is none. It's basically the economy is such that if you stop printing money and inflating everything, it would just collapse. It would just absolutely collapse. So there is no other way. It just, debt has to keep increasing. They're not doing it because they're nuts. They're not doing it because they're stupid. They're doing it because there is no alternative. These are very intelligent people. And yet they keep doing something which seems stupid. And the reason is either they are stupid or there is no alternative. I think there is no alternative. So they'll keep debasing the currency. So buy, in my opinion, anything that's, nailed down. Buy anything, consume anything. Buy a car, buy a chair, buy a house, buy a piece of land, buy Bitcoin, buy the S&P, buy anything. Buy gold, buy silver, buy cocoa, buy anything that's not perishable.
Mark, the second half of the year, as OPEC sort of sits to plan its meeting on July 1, is this going to be a focus, or would need to be on demand or supply? What is going to determine the direction of travel? It does feel like this manufactured economic activity, with all of the liquidity still sloshing around, preserving value. Does this feel like a demand-driven second half or a supply-constrained second half to get 80, to get the floor at 80, to maintain the 80 floor?
Well, I very much doubt whether supply is what will keep prices capped when we have not so good economic news. But on the demand side, the risks, to my way of thinking, for the global economy, taken on balance, are to the upside. So to me, it's more likely to be demand driven, with this consciousness that there is no shortage of supply out there. That's a fact, without enormous disruptions. And we can't.
I suppose the point ultimately I'm getting at is there a window here for OPEC to even consider unraveling these cuts, as the sort of rumors went over the weekend?
I don't think that's in their interest for the time being. I think they know that demand balance is quite delicate, and the very hint of basically turning on the taps in any shape or form, however marginal it's going to be, is probably going to see you could drive oil prices down to 75. And that's with the ambitious projects, particularly in the GCC countries, that's in no one's interest. So they will err on the side of caution a little bit like all the central banks are doing with rate cuts.
And when you take the outcome of the first quarter, we saw, as we said, prices rose through the first quarter as the narrative of OPEC of rate cuts coming very soon, lifting all those boats. And now, as rate cuts drifted away and through the second quarter so far, prices have come off. Is that a correlation for you? Does that change when cuts come back into focus?
To a certain extent, it comes in more into focus because, as much as I agree with Omar in terms of long-term trends, and I agree with Ross Clyde about, I think the whole yen dollar is much more important. I don't think at the end of the markets will, in the short term, basically look at the dollar and say, right, well, that's worth X, Y, Z on commodities. The longer term trend will be basically determined much more by economic fundamentals. But if we will go to a more positive story on rate cuts as we go through the second half of the year, and per se, that should be supportive.
Clyde, just to wrap us up on that China demand outlook for the second half. I mean, China appetite for oil imports in the second half will be determined by prices, not economic growth. So we can't be looking at the health or not health of the China macro picture. We need to look at where prices are. Does China this was a market or an outlook in which we were going to have a tighter second half from the global point of view. Does China trend look 10.8, does that seem like the import number for the second half?
No, actually, I would expect it to go slightly higher. There's a couple of structural reasons for that. Some new refineries coming on board, which means they have to buy oil for them. I would expect that there will be a little bit more economic growth. I'd expect to see a little bit more diesel and jet fuel demand in China as those parts of the economy that use those fuels recover. So I think, you know, I'd be more looking at a base somewhere above 11 million barrels a day rather than sort of closer to 10.5. What I do know is that, you know, if you look at the first 4 months of the year, China's growth in actual volume terms was something less than 300,000 barrels a day compared to the same 4 months in 23. So that's well behind the sort of predictions of even the IEA, and especially well behind OPEC Plus's or OPEC's predictions. So China, to make those kind of forecasts come true, they're going to have to start importing more. Will they? I think a lot of it depends on the price movements. If you keep the prices fairly steady, they'll start buying again because they'll get used to the current price level. But if prices accelerate, then they'll pull back and they'll take a little bit from inventories if they need to. So it is kind of price dependent. If the prices stay in this kind of 80 to 90 barrel range, I think Chinese imports will accelerate.
Well, we'll wrap it up there with the news just breaking that Emirates Airlines has made an absolute fortune in its annual report 23-24 with record profit at over $5 billion, up 71% year on year on record revenues. So lots of people traveling, lots of people willing to pay the big bucks to get on airplanes. That seems to be continuing. Clyde Russell, as always, wonderful. Thank you for your insights from Australia. Mark Ostwald all the way across in Europe, and Omar Najia in the middle here in Dubai. Thank you so much for your insights today. As we say, Brent oil starting the week, little changed. Will this continued downward trend that we've seen over the last few weeks continue? We'll have to see where that goes. Thank you so much, guys. All the best.
Thank you.
Thank you.
Thank you.